So thank you all for coming. Welcome. For those of you who don't know me, my name is Trish Mosser. I am the director of the Initiative on Central Banking and Financial Policy here at Columbia SEPA. I'm very, very pleased to have three very distinguished panelists today. I also want to thank our Dean Merritt Jano for encouraging me to put this panel together. So today's panel is about financial stability, and particularly the very important role that debt, or leverage, if you want to use that term, plays in maintaining both a stable financial system and a stable economy. Now, let me be clear here, debt finance is, it makes economies more efficient, it makes them more productive, it's pretty much a core component of all modern economic systems. But we also know full well that it creates fragility. And excessive amounts of indebtedness by households, by firms, within the financial sector, can really set the stage for future economic and financial instability, and of course, in the most extreme cases, large-scale financial crises. So in the panel today, we're basically going to discuss a bit of what we know. I love the fact that Moritz put what we know in the title of his talk. It's fantastic. It must have been why we asked him to go first. And I hope the panelists are also going to offer a few suggestions for policies to address the fragilities that excessive debt can cause. I won't give long introductions, but I do want to introduce the panelists. Probably, I guess I'll introduce each one just before they speak. So the first panelist, all the way down on my right, is Moritz Schulerack. He is a professor of economics at the University of Bonn. This year he happens to be here in New York visiting NYU. And he's also taught at both Sciences Po and at Cambridge University. His research, indeed, he has a series of research papers, particularly on the macroeconomic history of debt and the subsequent crises and recessions across many countries, some of it going back actually to the 19th century. He also has some recent research that looks a bit more closely at the relationship between indebtedness and economic inequality, and I hope he'll get a chance as we go along to mention a little bit of that as well. So with no further ado, let me turn it over to Moritz and get us going. Thank you.
Great. Pleasure to be here. Thanks for inviting me, everyone, to be on this panel. So what I'm going to do very briefly in the first 5 minutes is really not going to present an academic paper, but try to summarize, hope it's not like what we don't know about debt and the sort of causes of financial instability. And I'll obviously refer to my own work, but also the work that others have done. So what is it that we know? I think, and Trish mentioned the long-run perspective that some of our research has taken. What we do know, what's reasonably clear, is that financial instability episodes, financial crises, the episodes where sort of large-scale dislocations in the financial sector occur with, bank runs or bailouts and all these things that we have seen in the last decade as well, that these crises are typically, if you want to have sort of one phrase in your mind, they are credit booms gone bust. They happen after a prolonged period of strong expansion of the balance sheet of intermediaries, of debt and leverage growth in the overall economy. There's a whole industry at the IMF and other institutions that sort of uses that empirical insight that comes from the long-run macroeconomic data to develop early warning signals for financial crises. And these empirical models, they typically have a very large role for credit growth or credit over GDP changes. Sort of, there's a boom and then comes the bust, and there are various ways to pick up that boom. If you then go a little bit into the detail of these early warning models or crisis prediction models, then you'll find that something that I'm sure we'll discuss today in a little bit more detail, you improve the forecasting, the predictive ability of these models when you take on board asset prices, especially house prices, real estate prices, and also liquidity situation of the banking sector as additional predictors. And there's a really, like at the heart of the crisis dynamics, and I think that's kind of at least and Stein or Richard disagree, I'd be happy to discuss that. I think that sort of the heart of crisis dynamics is really that we have like, in crisis what happens is that there's a sudden repricing of a large pool of leveraged and, let me use the word as an economist, mispriced assets. Wherever that mispricing is coming from is the part that I'm going to talk about at the end or in 2 minutes. Namely, how do we explain that? But sort of the heart of crisis dynamics is to do with credit booms, the leveraging of assets, and real estate playing a big role. If we look at, does this work? If we look at sort of long-run history of the banking system, that real estate crisis instability connection becomes more prominent. What you see here is for 17 countries, 17 advanced industrial economies, a long-run time series for a mortgage credit, so credit secured against real estate relative to GDP, and non-mortgage credit, that's typical business lending or unsecured consumer lending, in the long run. And what you see here is that really like the expansion, that growth of the financial sector in this 20th century, if you follow that red line here, I'm sure this works, not on that screen. If you follow the red line, it's been really like the growth of finance. You want to understand why finance is so big. Look around Manhattan, finance plays a big role. It has a lot to do with the growth of real estate lending, of mortgage lending, so that a connection between the banking sector and the housing market has become very, very intimate. It's a good question why that has happened. Why have banks gone so much into real estate lending? What's the comparative advantage there? It's something to debate it. It definitely does one thing, and I think that's pretty clear also from what happened in 2008. It exposes the banking sector to a very large amount of market risk in terms of like systematic real estate house price risk. To what degree this is actually diversifiable or not is something to be seen. We've certainly seen that in some of the recent crises, real estate markets on a nationwide basis or even on a global basis tend to co-move. So that's something to keep in mind. It also means this is the other side of this lending borrowing relationship. This is the consumer, the household balance sheet, and just as we're all used to stress tests for banks, where you say like what happens to banks' balance sheets when asset prices drop, and in this work, we've done just the same for the household balance sheet. We said, like, what happens to the consumer balance sheet, the household balance sheet, when asset prices drop? And what this chart shows you, just like the amount of net equity or negative home equity that is in. This is only the U.S. That American households here divided by income groups have in response to a 20% asset price or house price shock drop of 20%. And you see like how this has gone up over time as well, in sync with that great leveraging of the household sector and linked to expanding mortgage credit overall. So like for the bottom 50% now, and also the 50 to 90, so the middle class and the low middle class are very, very exposed to that house price risk because their portfolios are dominated by houses. And you see that like a 20% drop leads to a loss or net equity of like roughly 10-12% of the aggregate income of that group. So that's a big relative exposure. Let me conclude by saying what we don't know, and I think what we don't know is first of all, where do these mispricing, these leveraged mispricing of assets, where does that come from? Why do smart people, bankers, and rational investors do this? Why do we all of a sudden wake up one morning and realize that maybe subprime mortgages are not quite as valuable as we thought they were? And there are two views about that, and they have both some empirical and theoretical merits. The first view is that it's all about incentives. I think we'll hear a little bit more about this today. There's not enough skin in the game. People take excessive risk because the payoff schemes from taking this risk are skewed. If you win, you become a millionaire or a billionaire these days, and if you lose, then society picks up the bill. If you believe that, then you want to increase capital buffers, you want to make people have more skin in the game and hope that this makes the financial system safer. There's another view which is kind of orthogonal or different to that, which is the old sort of Minsky-Kindleberger view, which says like, people do also crazy things with their own money, and the way to think about these mispricings and credit booms is more to think about sort of behavioral biases. There's recent papers by Giannaioli, Schleifer, Vishny, or Baron Young, Matt Barron from Cornell, for example, who say there's very little evidence that people who have more skin in the game actually behave more prudently, and maybe we need to think about sort of more in terms of behavioral factors that cause these, spurts of credit-fueled over-optimism, and then maybe macroprudential policies are the more prominent or the more promising policy tool to deal with that, and not, bank capital, because basically everyone is caught in the same heuristic or expectations bubble. So far from my side.
Okay, thank you. So our second panelist is Richard Vague. Richard's the managing partner of Gabriel Investments, an early stage venture capital fund, and the chair of the Governor Woods Foundation, which is a not-for-profit philanthropic organization. Previously, though, he was a co-founder and CEO of an energy company, but also, of particular relevance to today's discussion, he was the co-founder and CEO of two consumer banks, First USA and Juniper Financial. In 2014, he published a book, The Next Economic Disaster, Why It's Coming and How to Avoid It, that looks at the role in particular of private versus public debt in financial crises. He's working on a second book, I know, and I hope we'll hear a little bit about both those things.
Yeah, the first thing I'd like to do is try to put it into context. How do you advance it here?
You click there, yes.
Okay.
I don't know where to, yeah.
Okay. So we did something really simplistic here, which isn't supposed to be conclusive, but is supposed to give you kind of a sense of things. We took the fabulous database that Reinhardt and Rogoff have put together, which includes about 40 countries, and we picked those countries from 1960 forward. And we looked at it by type of crisis. They have stock market crisis, currency crisis, banking crisis, which is a financial crisis. But instead of just looking at it numerically, we multiplied those crises times the GDP of the country that was having the crisis. So you have kind of a GDP-weighted crisis here. And what's striking here is that banking, that doesn't work, does it? The blue bars are the primarily banking crises. So of all the crises in their database, it's the most prevalent. About 35% of all crises on this risk-weighted basis are banking crises. You contrast that against these two red bars right here, which are all the crises that stem from government debt or sovereign debt crises. This is something on the order of 2 or 3% of all the GDP-weighted crises since 1960 have had anything to do with sovereign debt. You also contrast this against the yellow bars on the right-hand side, which are the inflation-related crises. Again, these tend to relate to very small countries, and it's probably only 5 or 6% of all crises on a GDP-weighted basis are inflation crises. So the blue bar, banking crises or financial crises, are the things that we have concluded are more important and where we've decided to spend most of our time. So kind of with that orientation, we look at a few crises here. I'm going to show you about 4 of these. And you have a very telltale pattern. The red bars here are private debt to GDP, so you can compare it through time. And you would expect, and in fact in non-crisis periods, what you normally have is a very slight growth in that line, or maybe even kind of a flattish profile to those bars. But as Moritz has already said, when you have a financial crisis, you have very rapid private credit growth in a very compressed period of time. So you can see that, kind of a crescendo in 2007 and 2008. And what is also typical is that government debt is fairly benign as a percent of GDP in these lead-up periods. That's the blue bar. You can see it actually improves. And in fact, improving government debt to GDP is a little bit of a predictive fact, not a powerful one, Nevertheless, it's fairly typical for government debt to GDP to be improving prior to a crisis. That's because everybody's making a lot of money, everybody's paying a lot of taxes. The government, in fact, almost invariably concludes it's an economic miracle, right? So government debt is benign. And by the way, one other thing to note here from a preventive standpoint is that all the damage can happen in a very compressed period of time. As Trish said, we're looking at all crises in the sixth largest country in the world over a 200-year period, and it is not untypical at all for all of this damage to occur in 2 to 3 years. I would argue that at the end of 2005, a financial crisis in the United States and the world, presumably, was inevitable. The damage had already been done. People largely didn't figure it out until the summer of '07 or the fall of '07. But all that subprime debt came out between '03 and '05. That's pretty fast. So let's look at another one here. This is Japan in the 90s. Once again, it's a very compressed period of time. From 87 to 89 is when the real damage was done. By the time you get to late 89, early 1990, a crisis is inevitable. It takes Japan until 1998 to start really owning up to this and recapitalizing the banks. And again, what you have is this blue bar, government debt, is very benign and in fact improving going into the crisis period. And then as business revenues drop and they try to stimulate the economy, of course, government debt to GDP starts growing rapidly in the post-crisis period. Here's another one of my favorite ones. The red bar, you can see private debt to GDP grows dramatically in the period before the crash. Construction spending triples during the 20s, both on the residential and the mortgage side. Loans outstanding on the mortgage side double by 1928. Construction loans double by 1929. Mortgage delinquency doubles between 26 and 28. Office vacancy doubles in Manhattan between 27 and the end of 29. What you have here is a real estate crisis. What you have here is and mortgage is the biggest factor. By the way, there's one other real juicy one during the Depression. That is 18% of the stock market at the end of 29 or in the middle of 29 is the utility industry. 18% of the New York Stock Exchange. At an average PE of almost 60, with some of those stocks at almost 100 PE. And many of those companies, which by the way are fairly capital intensive, have triple leverage as folks are doing roll-up consolidations of utilities. You got yourself a credit crisis going into 28 and 29, even though most of the textbooks you'll read don't bother to talk about the 20s at all. And again, our familiar blue bar, government debt, becomes better and better and better as everybody's paying taxes and everybody's getting credit for an economic miracle. And it's even true when you go back into the 1800s. I mean, there's dozens of these crises to research, but in this case, even though the numbers as a percent of GDP are lower, the pattern is the same. So you have the red bar going up. Railroad debt plus bank debt alone accounts for most of that. The blue bar is Civil War debt, and you can see it's improving rapidly. But we build way too many railroads. Now, in the 20th century and the 21st century, it's mainly a real estate phenomenon. Back in the 19th century, real estate wasn't as big a factor. The biggest industry in the world at this time is the railroad industry. The New York Stock Exchange in 1900, 60% of the value of the New York Stock Exchange in 1900 is railroad stocks. Railroad is the mammoth industry of this century, and you can see a run-up in building way too many railroads is what precipitates the 73 crisis and the 93 crisis, by the way. So it's, same song, multiple verses. By the way, as a practical matter, the way we think about it is if private debt to GDP increases like 15 to 20% in about a 5-year period, and overall private debt is about 150% of GDP, you pretty much got yourself a crisis. It may take a while for it to run out. And we think from a macroprudential standpoint, if I were a regulator, what I would do is I would look and see anytime there's a year in which private debt to GDP increases by 3 to 4%, my antenna would go up. If you had a couple of years of that, I'd be all over it. You know, as a banker for 30-something years, I know the regulators, if they come into your institution, can plop themselves right down in the middle of your credit department and significantly influence your credit policy decisions. And if you happen to be those institutions that stopped requiring down payments, stopped looking for income, if you have a regulator right there beside you, it's going to make a fairly big difference in what you're able to do. The problem tends to be in almost any crisis, going back 200 years, you tend to have institutions that are not banks play a significant role because energetic, aggressive lenders that are trying to make a fortune try to find a kind of financial institution that's not that heavily regulated. It was the mortgage industry this most recent time. It's trust companies, S&Ls, it's wealth certificates in China and so forth and so on. There always tend to be 2 or 3 that are kind of outside the direct purview of the regulators. So that's something that needs to be thought about as we think about the potential for future crises.
Thank you, Richard. The final panelist is Stein Neuberberg, who is currently visiting professor in Columbia Business School this year, but his normal professional home base is a few blocks south of here, more than a few actually, at NYU, where he is the David Loeb Professor of Finance and the director of the Stern School Center for Real Estate Finance Research. As his title suggests, he's an expert in real estate finance, and if you haven't gotten the impression from the first 2 panelists that real estate's important, he will reinforce that, and just how special real estate can be. So,
Thank you,
it's all
Trish.
yours.
Thanks for inviting me to speak. So I just want to elaborate a little bit on what my 2 colleagues here on the panel have said so far. Right. So one thing we've learned from Moritz's work is that mortgage debt is really a key liability of the financial sector, and it has become increasingly a key liability of the financial sector. Maybe this is because corporations are now hoarding cash, self-financing themselves to a much larger degree than they used to. Think of all the cash that Apple sits on and stores away abroad, for example. But for whatever reason, mortgage debt is the bread and butter of our financial sector. On top of that, the financial sector is heavily levered, right? So leverage in the levered financial sector is something like 90%. That means that not a whole lot can go wrong to the value of the asset base before banks are essentially insolvent. And this is essentially what happened in the financial crisis, and this is what will happen again if we have another big asset shock to the balance sheet of the levered financial system. Now, you could say, well, that's just too bad for the bankers. They shouldn't have set them up that way. And if that shock materializes, they'll be the first ones to share in the damage. And I do think that there, in fact, is a lot of skin in the game in the financial sector. A lot of people did lose their jobs in the financial crisis. A lot of people lost a vast amount of wealth. But the problem is that that's, of course, not the end of the problem. The end of the problem is that the financial sector is critically important for the functioning of the real economy, the rest of the economy. And so, what form does that take? Well, so basically, once the banks are undercapitalized, they're going to stop lending to small and medium-sized enterprises in the non-financial sector. That's going to reduce their ability to invest, and ultimately the ability of the macroeconomy to grow. It's going to affect us through public debt. In fact, I thought one of the messages from Richard's public debt picture was that whenever there is a crisis, the government will inevitably step in and bail out the financial sector. And I think to a large extent, that's what you're seeing when you saw that blue bar go up. He pointed out the blue bars going down a little bit, but then you saw them massively shoot up as soon as the crisis starts. Well, that is the government issuing tons of debt in order to largely fund the bailout of the financial sector. Now, these are kind of ex post phenomena after the crisis has happened. Now, of course, if we live in this world where every 10 years or so, according to Reinhardt and Rogoff, we are in one of these financial crises, what you're going to see is that ex ante, banks are going to price for that, right? And so, they live in a risky world. Mortgage credit goes bust from time to time. So you and I will have to pay higher mortgage interest rates all the time in order to essentially provision for that future cost. So that's, of course, bad news, because if interest rates go up, credit spreads go up, people borrow less. That means that, again, fewer businesses, fewer investments get undertaken, fewer households can become homeowner, and so forth. Second, and then finally, kind of another corollary of that, I mean, these things really happen kind of jointly, is that, and I think this is an important thing that we tend to overlook, is that, you know, when debt is expensive, because there's all these financial crises every 10 years, then the financial sector shrinks. And so the way I view the financial sector, maybe a little bit unlike, you know, maybe more, it's just a little bit, is that I see the financial sector as like a pipe. And the role of the financial sector is to channel savings from folks that are, I'm going to call them depositors, that like to save in the form of money-like safe assets. They don't want to take a lot of risk. They like to save at short-term horizons. And the role of the financial sector is to channel the savings from those folks to the entrepreneurs, to the people who want to invest, to the homeowners who want to borrow and get a house. And so the bigger the pipe, the larger the financial sector, the more of that kind of productive channeling of savings the economy as a system can accomplish, right? And so when we think about limiting and regulating the financial sector, you know, that might have the advantage of limiting financial fragility. It might have the cost of shrinking the size of the pipes, right? And so it's ultimately a trade-off. And I think it's important to remember that there is this trade-off there. So one important aspect of the financial system in the modern world is that the government is heavily involved in it, right? Now, there are good reasons for this. You know, one, probably the most important reason is deposit insurance, right? So, you know, the 1870 period and the 1907 period, kind of prior to the establishment of the Fed, the U.S. had bank run after bank run. And you know, in response to that, the government introduced deposit insurance, and that has stayed with us. And I think in general, people think that's a good idea, that we you know, we have tried to avoid these bank runs. Now, on top of that, we have too big to fail guarantees, right? So even the deposits, even the liability of the banking sector beyond deposits are essentially also guaranteed by the government. Just remember what happened in the financial crisis when, you know, when the government ring-fenced all kinds of toxic assets that, for example, Citibank had on its balance sheet. Now, that does distort risk-taking incentives, though, because it creates this environment for bankers where, you know, as long as things are fine, you know, they privatize the profits. When things are really bad, when we have one of these credit crises, essentially the taxpayer will, or, you know, the government will have to step in, make the depositors whole, and will have to fund that, you know, either by increasing taxes today or by issuing debt and increasing taxes in the future. Now, to deal with that, you know, we've set up regulatory capital requirements, right? So the whole Basel-style regulatory capital regime is one that takes into account that bankers have those incentives and tries to limit that type of behavior. But it's hard because, as I pointed out before, you know, we are at the same time, the tighter we make, the more equity we force the banks to hold, the smaller the pipes become, and so the less of this productive intermediation activity we have in society. Right, so it's ultimately a calibration exercise, and that's how I think about macroprudential policy and how I, you know, have researched it in my own work, is to essentially try to figure out the right trade-off between kind of the size of the pipes and limiting financial fragility. The second point I wanted to, you know, point out, you know, given that I'm sitting here as the real estate representative, so to speak, is that the U.S. government has an enormous footprint in the mortgage market. I tend to joke to my students that, you know, Europe, where Moritz is from, has a capitalist mortgage finance system. The U.S. has a socialist mortgage finance system. And it's really true, because Fannie Mae, Freddie Mac, government-sponsored enterprises, until before the crisis, kind of these hybrid public-private entities, now fully part of the U.S. Treasury Department, they, you know, have their fingers over something like 70% of the U.S. mortgage market. Essentially, what they do is they sell default insurance to the bank. So the bank would make a mortgage, and then the bank would buy default insurance on that mortgage from the government. And until 2008, or probably even 10 or 11, that mortgage default insurance was massively underpriced. Now, what do you do as a bank when you can buy cheap insurance? You buy a lot of it. And in response, banks started to take risks elsewhere. They started to lever up. They started to make more mortgages, subprime mortgages. And so I think a lot of, you know, while I don't want to blame the government entirely for the financial crisis, there's certainly something to be said for, you know, this was an environment that prompted banks to take risk. And so, you know, I've written a piece where a large general equilibrium model of the housing finance system in the economy, where I show that if you actually start charging more for this default insurance, if Fannie and Freddie were to charge a lot more, then actually ironically, the financial sector would start taking more of that risk on its balance sheet, but on net, the economy would become a safer place because it would essentially reduce these incentives to gamble for the financial sector that the GSEs are creating. Okay. So lastly, let me conclude with a couple of thoughts about kind of the next debt crisis, right? I think it's unlikely to come from residential real estate. The US mortgage market was hit incredibly hard. Subprime is essentially gone. Other than actually the US government has taken over the subprime mortgage market through the Federal Housing Administration. But still, it's to a lesser degree and it's less outrageous than it used to be. And mortgage debt has kind of grown slowly and has kind of not grown faster than house price appreciation over the last 5-6 years. So I think commercial real estate is a different story. So that's kind of one area of vulnerability. Commercial real estate has had kind of a reversal of very loose lending standards in the last few years, kind of looser underwriting. And part of this is because there's a lot of money out there that is looking for yield. And we've been living in this zero yield environment for a very long time. And pension funds and insurance companies need to make money somewhere. And so commercial real estate has always been a bread and butter activity of those type of institutions. And they have poured tons of money into commercial real estate lending. They've done that kind of through the banking system. And indeed, there's a lot of regional banks in particular for whom commercial real estate is kind of their main activity. So they are very vulnerable to a massive shock in commercial real estate. And this has happened through the non-banking system, through the shadow banking system, right? So there's lots of companies that have set up so-called mezz lenders, mezzanine lender platforms. These could be REITs, publicly listed companies. These could be hedge funds that have set up platforms to make essentially very junior loans to commercial real estate. And I think a lot of the vulnerabilities are occurring in that shadow banking world as well. And then the second area I would want to point to is the high-yield corporate debt market. One of the things that people are probably underappreciate is just how much junk debt there is outstanding. By junk debt, we mean kind of below investment grade, low credit quality corporate debt typically for smaller and medium-sized firms. And a lot of this debt, I think, has been maybe not all of it, but this is intertwined with, I think, an interesting story, which is the private equity story. I mean, Richard mentioned every crisis has kind of its own perpetrators. It was the railroad industry in the 1870 crisis. I would not be surprised if the next crisis came from this corporate debt crisis and that we implicated the private equity funds in this crisis. And so here's the story. Private equity funds have this story where they say, well, we are really much better at running small and medium-sized firms than the owners of those companies. They're kind of amateurs. We're the professionals. Let us come in, take over these companies, and improve their operational efficiency. And then we'll bring them public a few years down the line and make our money that way. Whereas instead, what's been happening is that there's actually fairly little evidence that they're improving operational efficiencies, but instead they're levering up these companies a lot. They are typically doubling the debt of these companies. So they would take over a company that has 2 times EBITDA in debt, and they'd lever it up to 5 times EBITDA in debt. And moreover, they have much less strict rules and accounting gimmickry to really increase the leverage essentially without limit. Right, so when banks lend to a private company, to a publicly listed company, there are all kinds of rules that they have to follow. When they lend to one of these private companies, these PE funds can actually get away with a lot more debt, and so that's kind of an arbitrage opportunity, if you like. And so, that's what these PE funds do. They hope for the best. Leverage makes everybody look very smart when things go well, but of course we know how it can end as well. So I think that's an interesting area for concern. And then finally, there's China, which was mentioned. I'm not an expert in China at all, but I think there's kind of another potential issue there.
Yeah. Thank you all very much. So I'm going to take moderator's prerogative and ask a question or two, and then we'll open it up to everybody else. A couple of you mentioned policy prescriptions as we went along. And I'm sort of interested if I'll pretend I'm an IMF person for a minute or two, since they have their views about the potential usefulness of macroprudential policies are pretty well known. So the macroprudential policy tools, for the most part, that have been either tried or are spoken about the most in policy circles tend to be things like, first of all, they're largely applied to real estate. And secondly, they tend to be things like putting economy-wide limits on things like debt to income or loan-to-value ratios, as the case may be, in addition to obviously the potential for macroprudential policies, regulatory policy to the financial sector. So I would be curious to hear your views about this macroprudential policy toolkit, and given your, if I can summarize, your basic agreement about a large set of facts, but a little bit of disagreement underneath the surface perhaps, about what you think might be the most useful kinds of tools and in what circumstances. Who wants to go first?
I can go first and give you have more chance to think about it. It's a very important question. Let me maybe answer like a slightly twisted way. So when Richard showed his chart about the 1990s crises, and Stan mentioned as well, this was obviously a time when we would think there were plenty of bank runs, there was no bailout guarantees, there was no Federal Reserve, there was no deposit insurance. This was a time when, you know, sort of it's a little bit like for economists a great period, that because that's when we can test what happened, how stable a financial system is when the people who are acting really have a lot of skin in the game. This is your sort of laboratory scenario with like a no incentive, no moral hazard banking financial system that many people say we will get if we increase capital ratios a lot. Back then, capital ratios of US banks were, you know, in the 30s and 40s. You had partly double liability. And still, you had regular crises. So I'm not saying that sort of just increasing bank capital, which has been a big focus of the regulatory debate, I'm not saying this is a bad idea. It's it's for various reasons a very good idea, and we should absolutely do that. But it will not solve the issue of financial instability. People do funny things with when their own money is at stake. And that's, I think, where macroprudential policy can come in as a necessary ingredient and sort of complementary policy step to manage these boom-bust cycles in credit. I think LTV ratios, because the link between financial stability and the real estate sector is so close, decreasing maximum loan-to-value ratios is, Richard says, like, you smell something when credit is booming and everyone thinks real estate prices can only go up, and it's a safe one-way bet. That's probably the moment to use these policies, but, and that's, what economists love to do, they think about trade-offs, and of course there's a trade-off. The pipes get smaller in Stein's language, and we need to think very hard about the benefits coming out of these policies outweighing making the pipes smaller, maybe introducing some inefficiency into the financial sector and the macroeconomy as a whole. Effectively, you decrease borrowing limits, you artificially credit constrain some people, if you will. And there's and Larry Summers always uses this example about what is the story was like, I think if you've never missed a plane, you've spent too much time at the airport. And he always says that, you need to take some, if you're too risk averse, then you also have problems. You spend a lot of time in sitting in airports. I think that analogy is very nice, but it all depends on, missing a plane is not the end of the world. And he kind of mixes up these things. I think we've just seen how devastating financial crises can be, not only economically but also politically. To what they have very deep repercussions. In the 30s and certainly in the country I come from, these repercussions were terrible and devastating in various ways. So I think we need to think very hard about, is it worth giving up a little bit of financial or economic efficiency to insure against these really, really big shocks? Missing a plane, we all agree, is not the end of the world, but these crises inflict a lot of harm, so maybe it's worth, in that trade-off, erring a little bit on the side of caution, where until now, I think it's fair to say we were more on the Larry Summers side of things, okay, then we have a crisis, we can mop up after the mess, and things go on. I think we've seen in the last decade that these things are very, severe, dangerous, and take a lot of time. Mopping up is not as easy as we thought it was.
We're doing a lot of study on every one of these crises right now. And I can't think of a single occasion or an exception to the view that there was egregious behavior going on. It wasn't that folks had 35% debt to income ratio instead of 30, something like this. This was massive, flagrant misbehavior. And it was also, I mean, we're looking at the 1980s, you know, the junk bond, you know, Drexel and Milcom had gotten to the point where, you know, unlike in the late 70s and early 80s, by 83, 84, 85, there's massive misbehavior occurring. But Milken and those guys also had half the senators in the United States in their back pocket. They were the chief fundraisers for these guys. So I don't care where you look, it's easy to spot. It's just that the perpetrators have kind of bought off enough of the regulatory and government system to make things hard for people. And so I think, I absolutely think there are macroprudential things. I think a lot of it is the things the examiner would observe inside the institution when they're doing it, as much or more than just blanket universal policies. So I think it boils down to a certain extent to the courage of the regulatory community. One other thing, I'm not concerned about pipes being smaller, because what's really going on in these situations is gross overcapacity is being created. You've already got 1 million too many houses. It's not going to hurt anybody for folks not to lend as much for a couple of years. In fact, it will probably help everybody because the overcapacity that's been created will be absorbed. I think, you know, if from inside the banks, you're kind of happy for the pause to clean up. And I think, by the way, in my experience, people's memories are very short, and they may not lend aggressively for 3 or 4, 5, 6 years, but then they're right back at it. You know, I'm not worried about people's ability to regain their enthusiasm about lending. So, you know, there's this famous crisis in the United States in 1837 that we built canal, you know, the Erie Canal is a smash hit. Bondholders are paid back early. So every other state concludes, we got to have an Erie Canal too. So Pennsylvania's building one from nowhere to nowhere, and it's all being financed by wealthy Brits. And sure enough, all these things go bad, and the headlines in all the British papers in the early 40s are, we're never going to invest in another American security again. Americans are being refused membership in private clubs in London. By the late 1840s, the Brits are back in full force. I'm not worried about that.
So let me just say a few things about that based on some of the recent research I've done. So in terms of the macroprudential policy, I think countercyclical bank capital requirements can be very effective, where you basically, in good times, you know, force banks to hold more equity, with potentially allowing them to hold less equity in bad times, right? So basically saving for a rainy day. So that comes out as kind of the most effective policy in our work. The other thing that works well, I think, in the housing market is DTI constraints, so debt-to-income constraints. You know, like Richard said, one way of thinking about the subprime mortgage crisis is that what was really so toxic about these subprime mortgages is that there was gross misrepresentation of the income, the I in the DTI, right? And so people would basically lie. You had these ninja loans, no income, no job, no assets, where, you know, plumbers were making hundreds of thousands of dollars a year, and sometimes even dead people could get a mortgage. Clearly, they were not making any positive income, right? So their DTI ratio was infinity. And so, you know, based on some work by Dan Greenwald, who was my student at NYU, who's at MIT now, he's kind of shown that if we had much tighter DTI policies in place during the boom, which would have included actually knowing what these folks were making on their subprime mortgages, we would have essentially avoided a good chunk of that crisis. One other possibility in terms of policy responses I want to throw on the table, which I think is interesting, is kind of more of a wholesale contract reform idea. So, you know, why is it that we've kind of come to this model where, you know, everybody who wants to buy a house is going to put 5 or 10 or maybe 20% of their own money down and borrow the remainder, 80%, 90%, 95%? Why is that the right way of financing homeownership, right? It could be done a different way. You could imagine that financial institutions, maybe banks, maybe different types, maybe a fintech company. In fact, there is such a fintech company in San Francisco that is doing that right now. They put up some of your equity. You put up the remainder of your home equity. So it's a shared equity loan, if you like, and then you get a much smaller mortgage in addition, right? So why not get a 60% mortgage 15% debt equity coming from the fintech company, 15% equity coming from you. You build in a lot more equity in the system. That means now house prices have to go down more than 30% before you're going to walk away from that mortgage, at least. So you're building in a lot more equity, while not forcing people to actually put in 30% of their own money. Now, on the other side of this, there's a lot of institutional investors like pension funds and insurance companies that would be happy to take that 15% from that fintech company, right? So it's not that fintech company that's ultimately going to hold that 15%. It will be held by long-term investors that right now have a very hard time getting exposure to single-family residential real estate risk, and that would really love to have that exposure in a simple paper format. They're not going to want to hold these houses directly, but if they could hold it through some sort of structure, I think they'd be happy to do that. So I think creative thinking along those lines and along the line, and this is happening as we speak. This company in San Francisco is doing this. I think it potentially could also be an interesting way to go and to build in more resiliency into the system.
Great, thank you very much. So we've got 10 or 15 minutes. Well, actually, we'll go till 10 after, I think, if there's enough questions. So I'm happy to take questions from the floor. Yeah, I've got one right here. Could you identify yourself too, please?
Sure. Dominique Duorfreco. So on the question of the cost of mopping up, could you not argue that different crises have different macroeconomic consequences? So for instance, your graph, Richard, I would be very interested in your graph showing the size of GDPs associated with different types of crises. It'd be very interesting to do the same thing in terms of GDP losses. And in terms of your slide showing three possible sources of crisis, to me the one that has potentially the most macro consequences is number 3. So is there not a case to think about regulation, not just in terms of preventing risk-taking in general, but in terms of the potential impact of risk-taking on growth and the real economy?
You want to take this?
What do you guys?
I think it's an interesting idea. I think what you have in mind is something where we're trying to minimize loss given default, right? So given the crisis materializing, what kind of policies do we put in place that will limit the losses when that type of crisis occurs, and for what type of crisis are the losses the largest, right? So I think in general that sounds like an interesting idea. I don't know how we would go about that in practice and kind of how define. I mean, I guess we could look at Richard's table and for each type of crisis, look at historical averages for those losses, for those types of crises, and then kind of tilt our policies towards those, preventing those crises are the most costly.
Okay. Another question? Right here in front, and then we'll go back inside.
I like the idea that you were actually showing that crises happen again and again and again. Somehow we economists like to think that we want to have this kind of steady state systems that just work and never break. However, it seems to be in human nature that we just like to take more leverage so we can actually have more whatever we want at whatever time we can get it. What happens is that we always end up like having this cyclical behavior. So I have no answer for this, but I'm asking you, what do you think? Isn't the perspective of how we evaluate this wrong in like how to prevent crisis? Maybe we shouldn't go that way, and I guess goes a little bit in the lines that she said. But how do we actually deal with the crisis? Because we're going to have a crisis no matter what. And a lot of the policy making is sort of like putting controls in place to see how can we stop crisis. But it seems to be embedded into the economy that we are going to have a crisis. In fact, if we see some studies, for example, done by Claudio Borio from the BIS, we see that financial cycles tend to be a little bit longer, but they happen every 20, 15 years, and we crash somehow with different levels of severity.
So I think your statement is very wise in that this stems from human nature. People ask me a lot, why do booms happen? And I kind of turn it around and say, people are always trying to make bad loans. The things that surprise me more is benign periods rather than boom periods. So I think you're exactly right there. I don't necessarily think folks have been trying to prevent crises. You had a lot of disclaimers after the last one. Geithner, Bernanke, and on and on and on said it's impossible to predict crises. So I don't think it's really been tried, the mitigation piece of this. And even if it doesn't prevent them outright, if it softens them, I think it's a worthy goal to pursue. And the reason I feel that is it's not just the guilty parties that get hurt. I think of the 52 million mortgages in the United States in 2009, 10 to 15 million of them were underwater. And you had what I would consider to be, therefore, millions of households that had nothing to do with causing the crisis. Financial lives changed severely for 5, 10, 15 years. I met person after person who, they just got transferred across the country as a routine part of their job. They bought a $400,000 house, with a $350,000 mortgage, and all of a sudden the house is now worth $275,000. So they're underwater. Their income probably backs off because they're in a non-boom period. It's been 10 years and they haven't taken a vacation. They can't do some of the surgery their family members need. They can't actually go forward with. They aren't taking vacations. They aren't buying new cars. I think it's a worthy goal to try to be somewhat mitigating relative to these crises.
Yeah, there's one at the back and then up here.
Arjun Jaidev. So I have a question for Moritz and Richard. Can you just tell me from your research about private sector deleveraging, what are the kind of things which actually work for private sector deleveraging? Is it the government actually taking on the debt, or is it things like financial repression which have worked in the past?
Good question. Maybe a quick word on that question about the crisis prevention and how should we focus. I think what we know empirically is that there's a relatively close relationship between the amount of the size of the credit boom and the cost of the crisis. So again, there's I guess an argument to moderate the financial cycle. We will always have shocks, right? Something's going to happen. I guess what we should be after is prevent those big crises that kind of aren't shocks because they're like really man-made and in the making for a long time, and you can see them and smell them and spot them because the credit growth is so high and the asset price movement is so outrageous. Coming to the other side then is once the crisis struck, and then what we know again is the time it takes to recover, the severity of the recession, the deleveraging needs is a function of the previous build-up. What works, what has been the typical pattern in history is that a lot of that the public sector balance sheet takes over a lot of the private sector debt in one way or the other, be it through stabilization policies and sort of necessary to stabilize the real economy, or through the direct cost of bailing out the financial sector and then sort of supporting incomes as this deleveraging process goes on. I think there is we know much more about what's optimal, what works well on the side of the financial sector, which is, if you compare the European and the American response to the 2008 crisis, if you look at the banking sector, the recipe is pretty clear: clean up quickly, recapitalize, and just get on with it instead of dragging it out. On the for private sector balance sheets, it's much harder to do because you're talking about millions of contracts. My hunch is what works best is what to a large degree central banks have done, is reflate asset prices, which then it reduces the need for that deleveraging, which is something that arguably Japan has managed to do in the 90s, and which is the reason why it has has taken such a long time. But clearly, the problem is that the debts are relative, the price of the asset has fallen a lot relative to the debt. The debt is fixed, and if you can bring the asset price back up, the problem goes away.
There have been 92 cases. You hear politicians blithely say, we're going to grow our way out of this. So we kind of examine that, and in 67 countries since World War II, there have been 92 cases where either private debt to GDP came down 10%, or public debt came down 10%, or both. And in pretty much every case when private debt to GDP came down, it was because public debt to GDP went up, kind of dollar for dollar to offset it. The same is true in the other direction. Wherever you have had public debt coming down, it's been private debt growing, offsetting it. There's been a few cases beyond that. They tend to be high inflation or hyperinflation periods. So the depressing thing to me about this is there's maybe one instance where actually there was growth. By the way, the other thing that can help you is high net exports can do it, and there's a few examples of that. But as a practical matter, even though we blithely say we're going to grow our way out of that, it kind of never occurs.
Yeah, right here, in the gray.
Yes. Thank you very much for having the panel. I was just wondering if you think there's more, political strength that's required to glide overvalued asset prices down, and particularly we're talking a lot about a lot of things ex post. But when you look at a case study like Australia right now, when you're sitting, at a time when, DTI is at 7, 8, 9x, and you're feeling that, not enough macroprudential regulation has gone in place, and you're starting to look at, macroeconomic policy that might start lining up again. How do you think about that? Because there's been a lot of regulatory reluctance to preemptively sort of bring down asset prices.
What's your question exactly?
So, do you think there's more, that more political strength is required from the regulators?
Right. No, I think that's right. I was actually looking at house prices in Sydney this morning. They've gone up 80% since 2012. Right, that's a big number in just like over 5 years. And I think it's an interesting question why not more has been done to stop this. I mean, of course, to some extent, the question is, has this been supported by fundamentals, right? Clearly, cities are growing everywhere in the world. They're becoming large, important engines of growth. People, high-skilled people in particular, want to congregate in cities. If you look at Beijing house prices, they've also gone up a lot, but so have incomes, right? So price-to-income ratios have actually not gone up a whole lot. So I would like to know what that number looks like for Sydney. But I suspect that you're right, that price-to-income ratios have increased dramatically, right? And so in addition to the macroprudential and the macroeconomic, consequences of a crash that we've been debating, there's kind of this issue of affordability as well, right? So how do we, if indeed it is true that our cities are engines of growth, how do we make sure that people can actually afford to live there? I think this is a big problem in cities like New York City, right? And economists have actually calculated that in some sense our cities are far too small. Like New York City should be 30% larger than it is today. If you were a social planner and you could kind of plunk the population across U.S. cities, you would actually put 30% more people in New York City. Now, everybody who takes the 4, 5, 6 knows why that's not a good solution, and why we can with the present infrastructure not support that. But very high house prices are an obvious reason why this is not happening, right? And so, in addition to macroprudential political solutions, there are and we haven't really touched on this. There's a whole other response, which is on the housing supply side, which is zoning, deregulations. There is absolutely no reason why we couldn't easily house 30% more people in New York City. It's not a problem at all. We just build vertically. Everybody who's been to Hong Kong realizes that our density is far too low. One of the most shocking numbers about New York City is that density today is lower in New York City than it was in 1910. Now, in 1910, we had lots of tenements, and that's obviously not something I'm advocating for. But we can house a lot more people here, and the reason we aren't is because of very tight zoning laws, right? And so in economics, one thing that always works to bring prices down is to increase the supply, right? And so, we don't need lots of other kind of crazy policies, just allow people to build, and it's going to go a long way towards reducing prices. And I think every major city, including Sydney, is struggling with this incredibly tight zoning policies that is essentially preventing that from happening.
Yeah, and if I can just add, because I've been thinking about this a lot, and I'm absolutely with Stein here. The problem obviously is with the zoning laws is that the people who own the houses in New York City have no interest in relaxing them, and partly because they have a lot of debt against high house prices, and they're taking a big net wealth hit. But the other thing is, I think that's maybe the more general question behind what you say. I think it's important to realize that housing is the most, if you will, democratic asset out there. It's the one that's most equally distributed. 60, 70% of the population are homeowners. So house price booms are a fantastic thing. That is like the asset that goes up that makes almost everyone happy. So it's not like house price booms are like for academics. There's something we think about them, like there's something dangerous we need to think about. For for normal people, they're a great thing. They get richer, like at least on paper. I still need to live somewhere, but they're a great thing. And if you think about, we talk a lot about inequality. If you think about sort of from a perspective of wealth inequality, rising house prices are an equalizing factor because like almost everyone owns houses and only the top 10 own the equity. So if house prices rise stronger than the equity market, that makes, at least in terms of wealth, the society a little bit more equal. So the political economy of intervening in these house price booms is very, very complicated. Not only the zoning is one, but also like the feel-good factor. I don't know which politician is going to, really act on it.
I'd add to that. The increase in real estate prices is largely and directly a function of the overlending itself. That's why the prices go up. Once you pull back on lending, that will cause prices to reverse. It's that direct and it's that simple. So your problem is not only difficult, it's really difficult for that reason. Because you are going to cause, on paper at any rate, a backing off of real estate values, which is going to create more of a backlash than the cessation of the boom itself. But it's got to happen at some point in time. The longer it doesn't happen, the worse the unwinding is going to be.
And we grow out of it.
Right here in the first
We
row.
grow out of it.
My name is Navid Zubair and I'm a student of energy and finance. I wanted to hear more about China today, but surprisingly there is only so much there. So the question is, why aren't people not too much worried about China? The background is that the debt to GDP ratio is more than 300%, the housing market is relatively softly, and China plans to spend more than $1 trillion across 80 countries to develop their One Belt, One Road corridor. So it's not in a mood to deleverage anytime soon, but they're in certain quarters of the market. There's not, any lack of optimism about China as an engine of growth. So should we be worried? Maybe not. Any thoughts?
China's the greatest growth in private credit in the history of the world, or the non-government credit.
Yeah.
Since 2008, they've added $20 trillion in what we think of as private debt. There's no comparison to what's going on there. The thing that I would say, though, is Japan's crisis was more or less fully baked in by 1989, 1990. It took 15 years for that to unwind, partly because they were in denial, partly because they knew to prop it up and string it out, so forth. I don't think there's any nation that is more capable of obfuscating things and dragging things out than China. They had a crisis in 99. The bad debt in the banks in China in 99 was 35 to 40% of loans. In the U.S., if you have 4, 5, 6% bad debt to loans, the bank fails. And what they did at that time is they let them roll it into bad banks and take paper back as equity, capital, in the institution. China owns each of the pieces. It owns the rating agencies, the regulators, the banks, the customers, everything. So I think there's going to be a reversal there. I think they're going to be capable of stringing it out for every bit as long as Japan. I think we'll see a slowdown in GDP. I think we'll see a reversal in non-agricultural commodity prices. I think they're going to be able to paper over the failure of the institution themselves. We'll feel it. It'll be profound. I think they'll manage it a little bit more effectively than most.
I think one big difference is that private mortgage debt held by households is very small in China relative to the rest of the world. And so, a purely debt-driven housing crash is kind of less likely in China. But I think Richard is right. Ultimately, these high house prices show up in the form of multiple generations combining all their savings to buy one little apartment in Beijing. And so the society is massively misallocating its resources towards real estate. And that's the nature of the crisis, I think. And so ultimately, this is going to show up in the form of lower GDP growth, lower residential investment. And I think that's where the crisis is going to be. It's going to look less like the U.S. mortgage crisis.
Yes, right.
Hopefully this is a quicker question. I was just curious, as we're thinking about the future crises, and especially with these PE funds tied to these junk corporates, which are smaller corporates, do you see that as a true contingent liability for a government to have to push a bailout? Or is it just the financial system is so integrated with those failings it will then bleed into failure of the banks?
Yeah, it's a good question. Who's going to be the ultimate victim of this if this comes to pass? And I think it's true that, a lot of this is very wealthy private individuals who are investing in PE funds that will, they'll lose that money and no damage done. There's still a lot more money there, right? So in that sense, it's less of an issue. However, there's a lot of pension funds that are investing the money of the teachers and the firemen and so forth that are also massively invested in these PE funds. And I think that's potentially gonna maybe not jeopardize retirement security, but further damage the already little savings that Americans are doing for their retirement, right? And so I think it's, again, less of a systemically risky type of crisis, because I think this activity is small enough in the big scheme of things relative to, let's call it, residential mortgage lending. But nevertheless, I think it's going to hurt some folks, including some folks that you might not necessarily think about as PE investors.
Yeah, I think the systemic consequences of a crisis have to do with how large the sector is. There's about 10 trillion in residential mortgages, about 3 trillion in commercial real estate. So if you have a crisis in real estate, if you think about 2007, the banking industry had about $1.5 trillion in capital. The real estate industry had about 13 trillion in loans outstanding. So a 10% correction there was $1.3 trillion. That approaches the amount of capital in the system. In 2014, we had an energy debt crisis, right? But the energy sector is only about $1 trillion. So a 20% correction, and at that time we rebuilt capital to $2 trillion. So as bad as it could possibly be, was about 200 billion against a $2 trillion capital base. So that's why the way I think about whether a sector crisis has broader consequences or not.
Yes, there's a question over here. No? Okay, wonderful. Thank you very, very much. Please join me in thanking